Okay, so we're going to now continue our lessons, and today we're going to start talking about the debit and credit theory. Debit and credit theory is the most important concept. It is a concept that the entire accounting, the future of your accounting lessons, classes, and of course a lot of accounting and finance depends on this. It is the most fundamental concept in accounting, and we're going to start talking about it today. So the agenda for today is as follows. You can see we're going to briefly discuss source documents. We're going to talk about the objectivity principle as one of the accounting principles, and moving on to ledger accounts and important features of ledger accounts, and then of course the debit credit rules and some of the other things, and we will conclude with the importance of trial balance. So what are source documents? Source documents are those documents that accountants or accounting experts refer to as the receipts or original documents. These documents are extremely vital to the system of accounting. This is the actual proof, your actual evidence that you have spent the money or you're expecting some kind of money. This requires you to really understand that without source documents, there is no transaction. And remember from prior videos, we talked about the fact that accounting records all economic phenomena. So in order for this economic phenomena to be recorded, you have to have proof. So assuming that you spend $10 on an office supplies, or on some kind of a meal, or on wages or something, you have to have proof. You have to have paper document, source document that reflects this fact. The fact that you have to have a proof is the actual concept behind objectivity principle. So source documents are the original papers, as I have mentioned to you. They are extremely critical. Accounting entries are made from these source documents, and they must be kept. The most important source document are your bank account transactions or statements. They are extremely critical as far as source documents are concerned. So coming back to the objectivity principle, all these accounting records or source documents are kept because accounting needs to be done objectively. There is no subjectivity in here. So you cannot say that perhaps I spent $10 on this item. There's no such thing as perhaps or as an estimate. You're looking at an actual receipt or an evidence or some kind of a supporting document suggesting how much you have spent. So amounts are determined using these documents. They are not based on personal opinions. It's very, very important to understand the difference between personal opinions and source documents. So we need source documents in order for us to get an understanding of how much we have spent or how much the transaction should be recorded for. So moving on to ledger accounts. What is a ledger account? A ledger account, simply put, is an account that is a record of all the documents in that particular account. So there is one account for each asset, there is one account for each liability, one account for each equity. Meaning that if you have 3 assets, you should have 3 ledger accounts. If you have 4 liabilities, you should have 4 ledger accounts, and so on. So each ledger account records the changes in that particular type of asset, liability, or equity. Yeah, we will look at all those things as you guys do some exercises and as you move along in the chapter, in the next chapters. But in general, each ledger account is very, very specific, so you can take a look at where the money was actually spent in your business or even personally. A ledger is a group of accounts. Ledger accounts are often referred to as T accounts because they are shaped or written in that fashion. You can take a look at from this slide that a ledger account, each one of them is shaped as a T account, and there's a group of these accounts, and one group is called assets, the other group is called liabilities and equity. So each account, for example, the cash account, it's there's two sides to it, two sides to the T, one side and of course the other side. There's the left side and there's the right side. There is the left and the right sides. The left side is referred to as the debit side, or in short, the DR side. The right side is referred to as the credit side, or in short, the CR side. Extremely important to understand that in accounting, debit and credit do not mean anything else except left and right. Except left and right. They do not imply, all those debit cards or credit cards. There's no such thing. It just means that it's on one side of the T account or the other. So some of the important features of ledger accounts, we talked briefly about it already. Each individual balance sheet item is given its own T account with the name of the item at the top. So I showed you an example earlier, like the cash account. The dollar figure for each item is recorded in the account on the first line. This is the beginning value for the account. As you add transactions, you go down on the T account, and at the end there is obviously the balance at the end. For any item, the correct side of its beginning value is the side on which the item itself would appear in the accounting equation. So again, everything ties back to the accounting equation. Assets equals liabilities plus owner's equity. So you can see that assets are on the left side of the equation and liabilities and equities are on the right side of the equation. This implies that in normal balance for assets is on the left side, which is the debit side of the T account. In normal balance for liabilities and equities is the right side of the T account, which is the credit side. So that's why we start with those sides of the accounting of the T account for the T accounts. Now, this next slide is something that we really need you to understand. I know it's difficult to comprehend some of this material at the first go, but as I had said earlier, as you do exercises and as you do chapter 4 and chapter 5 along with this these lessons, you will definitely get a grasp of the accounting rules or the debit and credit rules. So in order for you to make it very, very easy, I've put this slide visually. You can see that we start with the accounting equation. Assets equal liabilities plus equities, and then assets are you can see in the visual, assets have the left side or the right side. The left side is the debit side, the right side is the credit side. And liabilities, you can see same thing, debits and credit, and equities you see the same thing with debits and credit. Now you can also see the plus minus signs or the increase and decrease signs. That is critical to understand, that if it is an asset, debit means it increases and credit means it decreases. So once again, if it's an asset, debit means it increases, credit means it decreases. And liabilities and equities are opposite. So in liabilities and equities, credits increase and debits decrease. Now, what we mean by this increase and decrease is that as you enter transactions on the T accounts, those values are increasing or decreasing on those sides. Yeah? It is extremely, extremely critical for everyone to understand the relationship between debits and credits and assets and liabilities and equities and how they affect each other. So, remember, debit means the left side of the account, credit means the right side of the account. It has no other meaning in accounting. For each type of account, its record increases from its beginning value side and decreases on the other side. So you saw that assets, you have an increase in debit and a decrease in credit. And you always start off assets on the debit side. And liabilities and equities are of course the opposite. So this is very, very, very important for everyone to understand that debit and credit rules are critical to the foundation of accounting, and you can see that all these rules clearly are a next step of the accounting equation, which is assets equals liabilities plus equities. So I will stop it here and continue our lesson tomorrow. And again, just want to emphasize that debits and credits are the fundamental, debits and credit rules are fundamental to accounting, and we must understand. And as you do now exercises to understand and grasp this, please refer back to these PowerPoint slides and to this lesson as you go through your debits and credits concepts. Very briefly, I also would like to emphasize the fact that there is a great video on YouTube done by Mr. Colin Dodds in BC, DODDS, and it's Debit and Credit Theory song, and it is a very, very captivating song, and it actually goes through some of the basics of accounting. And if you have some time, please listen to it or please watch the video again, but that would be your choice. So at the end, just like every other lesson, thank you for watching, and remember, ARTW, accounting rules the world.